Welcome to Bitcoin Fixes This, where we explore the impact that Bitcoin will have in all aspects of society. Today's guest is Parker Lewis, Head of Business Development at Unchained Capital. We talk about one of the greatest lies about money out there, how incentives are misaligned in the financial system, and how Bitcoin changes the management of money. Parker also tells us his story of how he learned about the Fed and Bitcoin coming from a background of investment banking at Deutsche Bank. Parker Lewis, how you doing?
Doing well. Good to be in person here at Unchained Capital.
Yeah, how has life been for you the last few months?
I really think Austin in general has remained fairly normal, but effectively March 12th, coinciding with Bitcoin's drastic volatility, we essentially went from a non-remote company to a remote company, and so it has felt a little bit isolating. But kind of all things considered and keeping things in perspective, we're feeling fairly lucky to be working in the Bitcoin world given everything that's going on in the world because of the setup, but then also we are able to work remotely, and there's a lot of people who don't have that ability and have been impacted by this. So while it has kind of caused adjustments, definitely kind of trying to think of things in perspective and lucky to be in the position where we are.
Yeah, no doubt about that. There's so many people that are thinking about their jobs and careers and things like that, and I can't imagine what they're going through. But speaking of that, what's your background? What did you study? What led you to where you are now, I guess?
So I studied economics in school, and it was funny. Because I had the same thought, and I saw a tweet yesterday that talked about. Somebody had read the first couple chapters of Safe's book and basically said, and my whole college education has officially gone out the window. And that was really kind of how I felt once I had met Safe and not just read the book, but then started to think about monetary economics. So studied economics in school, but don't really feel like I got an education until I got into Bitcoin. After school, ended up going and working for an investment bank, worked for Deutsche Bank in and around the financial crisis from 2006 to 2009, which was an interesting period to be there specifically. Then left investment banking, worked in restructuring, so a lot of creditor side workout, understood the not just the credit system, but more so kind of how to work out debt when it kind of defaults and becomes bad, and then help really rehab companies that were in bankruptcy. Ultimately ended up joining a hedge fund thereafter, focused on distressed credit, but really then global macro, and started understanding really a lot about global macro landscape, interest rates, currencies, and that's really where I spent a lot of time, even though I had worked for an investment bank and probably I think the most globally systemic bank in the world in Deutsche Bank, but didn't really understand what was happening in the financial crisis around me. I was just out of school, and when I was working for a hedge fund in Dallas, really started going back and understanding the Fed and QE, and then understanding the implications of what would then happen when the Fed began to unwind the balance sheet. And that was kind of in around the time that I was also learning about Bitcoin. So traditional financial services, a background, economics in school, and now kind of I feel like Bitcoin has re-educated me on more things than just money.
Well, that's interesting, because you had to go back and study despite having learned all that. What led you down that rabbit hole of figuring out what the Fed does and how they put money on their balance sheets and things like that?
I'd say it's really twofold. One piece serendipitous, and then the other side just a function of my job, working for a hedge fund. The first side was I was asked specifically to go do diligence on a gold company in Canada, and at that time I kind of was aware of what Bitcoin was, but the company was called BitGold. And I reached out to our friend Will Cole, who's now working here at Unchained with us, and asked him whether or not it had anything to do with Bitcoin, because it talked about, the name was BitGold, and it talked about blockchain. And Will ultimately connected me with Safe, because after he looked at it for just a hot second, told me that it had nothing to do with Bitcoin, but he knew somebody that knew a lot about monetary economics and gold. So I was able to meet Safe, and then also the two co-founders at BitGold, they were also kind of very knowledgeable about monetary economics, and it really just opened up a whole kind of worldview, or maybe worldview is not the right way to say it, but just a side of economics that I had never considered. And so that really piqued kind of intellectual curiosity in something within the field that I was theoretically educated on, but had never really engaged in. At that same time, it was 2016 timeframe or early 2016, the Federal Reserve had started to signal that it had already begun to raise short-term interest rates, but it hadn't yet begun to unwind its balance sheet and essentially attempt to undo what it had done in the aftermath of the financial crisis. And one of the key focuses of what I was doing at Unchained Capital at the time, the firm had kind of shifted its focus. It had always been doing global macro, but it was doing a lot more global macro investing. And so many people key off around what the Fed is going to do and how that's going to impact financial markets. And as I was trying to distill down kind of what my expectations were from the least common denominator, centering around what happens when the Fed unwinds its balance sheet, the best place to start would be what I was thinking of it as a reverse order of operations of when they did QE. So in order for me to think about that, I felt like I needed to understand realistically at a root level what happened kind of on the way in to be able to have some informed perspective of what would happen on the way out.
That's so interesting because you worked in banking for so long, and then it took you many years into your career before you actually got around to understanding what the Fed actually does and how they operate.
Yeah, and I think that's really because if you think about anybody, if you think about Deutsche Bank as a company, when I was working in investment banking, it's an 80,000 person company. I was working in the mergers and acquisitions group, evaluating single transactions, albeit they were large transactions, but working in I don't want to say a small corner of the bank, but working in one specialized function within the bank, and not necessarily also being at that time just out of college. You have far fewer world experiences, kind of being thrown to the wolves. It's kind of baptism by fire, essentially. And so you're trying to figure out just kind of the one thing that it is you're doing, and that really restricts your ability, just on the one hand by experience, but on the other hand just a skill set to really being able to understand the full picture. And so I think, if I look back on my history, it was really, Deutsche Bank, I was understanding how to value companies, how to review financial statements. In restructuring, I was really kind of understanding more about how to run businesses, and particularly running businesses that had defaulted on debt or needed their balance sheet restructured. And then it was really not until Heyman where, because it was in many ways global macro focused, to be able to step back and look at the system as a whole, because when you're it's easy to get lost in the weeds, and if you're focused on one area of a bank or doing one specific function, you don't necessarily in the day-to-day function of your job understand how it's kind of impacting a market as a whole, or if you were to kind of add 10 banks together and look at how they're all operating, what the kind of system level risk would look. And so, one of those, a corollary to that would be somebody that's writing mortgages that contributed to the mortgage crisis. They probably had no idea, kind of, they're sitting writing individual mortgages. They don't necessarily know how they're being packaged up into mortgage-backed securities, or then how people are writing derivatives off them. So it's very easy to be lost in the weeds when you're doing specific functions, and it really requires abstracting up to a higher level to then and really think about it. Because when it was probably an overused analogy, but it really was like peeling back layers of the onion, like trying to really understand QE. It led to a lot of what was that specifically, and then it's like a whole nother rabbit hole, and it ultimately led me to the point of thinking about the credit system as a whole, thinking about leverage in terms of the amount of debt that's in the system versus actually the amount of dollars, and really understanding, okay, why is it that QE, like, it's impossible for the Fed not to get into the situation where they're putting more money into the system, because the whole purpose of QE is to expand the credit system, and in my view, that is the source of the problem. So it is kind of in certain ways interesting, and I kind of do view it in many ways as coming full circle, having worked at Deutsche Bank in the crisis, to then effectively 10 years later really spending the time to go back to understand what was happening around the time.
Yeah, it's so interesting that you had to learn everything despite having been in the industry for so long. What made you get into the investment banking industry in the first place?
No better explanation than herd mentality, I'd say. I went to school at Duke, and a lot of people go from Duke to investment banking, and there was some appeal to going and working on Wall Street and in New York, and so it was kind of not necessarily having a clear vision of what I wanted to do for the next 10 years or 20 years, and it was a kind of good place to get in the action and learn a core skill set. So there wasn't a grand plan when I decided to do it, other than I knew I would learn a lot, and that it would be good experience that I could leverage thereafter. But once people ask me like, hey, would you go do investment banking? I would say I'm glad that I did it, but I wouldn't recommend it to other people. Essentially.
So why is that? Why wouldn't you recommend other people?
Now a decade later, it's easy to look back on and say, hey, I'm glad I had done it. But on the other side, I think a lot of people, and I was recently listening to a podcast that Elon Musk did with Joe Rogan, where he made the comment that too many of our, and I don't refer to myself self-referentially as smart, but too many of our resources essentially go into banking and law, and that I think that it would be far more productive. Things actually have to be made in the world. Like people make things, and so I think looking back, I did learn a lot, got a lot of great experience, but it would, probably people's time would be better served after actually focusing in on something that they're passionate about. Having an actual skill in building a product or building a service or offering a service that more tangibly provides other people some amount of, kind of value in the world beyond kind of moving. So
that's interesting, because you're sort of suggesting that banking and law and things like that, they're kind of zero-sum games in a way. Like you're not actually producing goods. Am I getting that right?
I would say that there's certainly value in banking. There's certainly value in the law. I think that there's a limitation of that, where the more that you're financially engineering, there's just diminishing marginal returns. And so there is some value in being able to allocate capital and know how to say, person A has a project that they need to build, and person B has capital, and putting them together. I think that there is some inherent level of value to that. But I think, and I don't have the number specifically, but if the financial services world consumes like 16% of GDP, it's like, what is the right number? That's probably like far too high of a number. I don't, have I'm not all knowing, so I don't know what the right number is, but I do know that, when you think about the things that you consume and the things that tangibly make, your life better or my life better, they're different things, but they're more tangible objects that exist in the world that we actually consume, or the houses that we live in, the cars that we drive, those type of things, and that there's an inherent limitation to the point of probably being not just not productive, but being counterproductive to spending so much time and energy, financially and engineering the world rather than actually being in the world and producing goods and services.
Are you suggesting that banking is bloated?
I would say that once you start to understand the size of the credit system, that there's kind of no other conclusion that you could come to that the system would not be as large as it is if not for centralization and the function of the Fed to allow it to exist that way. And that in an unmanipulated world, that sector would naturally be small.
Well, so you're suggesting that it is kind of bloated, but there's obviously tons and tons of people that work in banking. How do they sort of justify what they're doing? Because in a sense, if it is bloated, then a lot of those people are really just taking wealth from other people.
Well, I think if I was to simplify it, it would be, in certain ways, they are delivering some value. And then it's, kind of like, okay, well, how much value is derived from capital allocation and financial engineering versus, manufacturing some good or providing, some software service. And really, at a root level, money is supposed to be the arbiter that helps people communicate preferences in the world and allows an economy to essentially allocate resources. The money's a tool. And that in a world where you're manipulating the money supply and that it effectively becomes a debt or credit driven money supply, that the money is communicating preferences that it otherwise wouldn't be, and that people are in certain ways rationally acting on signals that say, if I perform this function, I get rewarded in this amount of money, so I'm going to go pursue that as an activity. In that sense, it's rational. People are reacting to price signals and incentives. I think that there's a fundamental question that was, if the Fed didn't exist, and if banks didn't get bailouts, and if we didn't live in a world of monetary expansion, that the pricing functions and the incentive mechanisms to pay people certain amounts of money for a perceived value that's being delivered in the world would be fundamentally different, such that they would be reacting to a different set of pricing mechanisms or a different pricing mechanism that would essentially be more true or have the least amount of distortion in it. And naturally they would say, oh, well, I can actually be paid more to performing a different function because these are the preferences of that economy. So I don't think of it as a world as like, people are just, in the banking sector are just taking other people's wealth. They're rationally responding to price signals that are rewarding certain types of behavior, but it's a function of a manipulated money supply that's creating those incentives in that way. And that if that didn't exist, they'd likely be doing something else, and that there would be other functions to perform based on a different kind of preference set in an unmanipulated.
So what is the problem of incentive here? Why is it that so many people are motivated to become investment bankers, or 16% of GDP goes into banking? What's the wrong signal that's being sent? What's the problem in banking?
I think the root of it is that there's and not on an individual level, but at a system level that then feeds down into banks, and then the people that run those banks, and then kind of trickle down to individuals within those banks, is that you have a system that inherently has a massive amount of So we saw it in 2008 where we essentially, the Fed in early 2008 reduced interest rates, I think 7 or 8 times, all the way to 0. And then they did QE, but then there was also the TARP program and the bank bailouts, bank bailouts and AIGs. So when you have banks that are essentially taking risks that they otherwise shouldn't be, and then they're not penalized for that, and that they're bailed out, that there becomes an expectation that same type of activity will occur. And when you have that expectation, then you take risks that you otherwise wouldn't, and that's essentially so when if I was to explain that on a micro level, someone does a real estate transaction, and there's probably 7 percentage points of that real estate transaction that goes to real estate fees and mortgage fees, right? And so if you have a housing sector that's inherently propped up by the easy access to credit, where people are, when they're buying a home, they're not really buying the home, they're putting 10 to 20% down, and then a bank's providing funding of 80%, that 6 to 7% of money that gets raked off of value of real estate ultimately trickles down to many different functions within that supply chain, getting people mortgages. And so, like if we then start from that root level of an individual mortgage to people then packaging mortgage-backed securities, the amount of mortgages that exist in the world wouldn't exist to the level that they do if there wasn't cheap access to credit. So the pricing mechanism or the pricing signal is, hey, if I perform this mortgage function, I'll be rewarded handsomely. Now the individual at the bottom layer, they don't necessarily know that it's all enabled by the fact that the Fed is providing cheap access to credit for the banks for that to exist. But if it didn't, then the value of, say, real estate relative to all other functions in the economy will be lower, such that the kind of reward for performing that function would be different, and people would be more likely to pursue a different activity rather than what it is doing, if that makes sense.
Yeah, so you're suggesting basically that banking functions have a much higher reward, and because of the easy credit, something like that, which...
Yeah, I would say that the value of financial assets, the value of real estate, all of them are propped up disproportionately as a function of the credit system. The credit system is the size that it is exclusively, I don't want to say exclusively, it is principally driven through the functions of the Fed. and that each time that credit system and the value of financial assets tries to contract, the Fed takes actions to reverse that course and to allow the incentive structure to be maintained rather than to be reset. And so, every economic incentive becomes a derivative of ultimately the value of those assets. And so if the Fed, through its actions of QE and monetary debasement, are propping those up, that naturally goes down to certain sectors particularly advantaged by banking. So it's hard to unpackage and to drive it all the way down to individual decision points, but it is easier to abstract to that highest level to say, okay, well, if this world didn't exist, would the incentive structure go away with it? I think my conclusion.
Okay. What makes investment banking so profitable? Can you really tie it back to the Fed's monetary policy?
I wouldn't restrict all that the banks do to investment banking. So I would say, holistically, if you look at kind of a global investment bank or global bank, and they do investment banking and they do sales and trading, where they're trading stocks on behalf of individuals that hold stocks in their investment accounts, or for pension funds, to equity research, to a more commercial side of banking, which is financing real estate. That all of those functions are kind of in aggregate materially advantaged via the Fed providing cheap access. So if I was thinking about investment banking specifically, if I was to lay out a few economic factors, it's in March when the value of the stock market started to collapse. Investment banking generally charges fees. Like say if I was doing a mergers and acquisition transaction, two companies that are worth $5 billion combined, and investment banking at 1%.
Wow.
Well, and obviously they don't just, if it's a $50 billion transaction, it's not still 1%. There's some, kind of
wiggle room. Yeah.
Wiggle room where the basis points come down, but the overall reward goes up, essentially in terms of the fees. Well, say the stock market's collapsing, say a company that was worth $5 billion, one day, if the Fed didn't come in and support those financial assets via QE, well, what if those companies were only worth $1 billion? What's 1% of $1 billion versus 1% of $5 billion? Or if you combine the two companies, what's 1% of $2 billion versus 10? So the type of assets that are disproportionately benefited from the function of QE are anything that's dependent on the credit system, which are principally financial assets, but it's not just bonds, it's stocks and bonds. And so you can think about it in a micro world of individually kind of how certain incentive structures can be manipulated, because in the world where the stock market's crashing, anything that's a derivative of that, and particularly anything that's transactional around that, is an impact. At the same time that the stock market was collapsing, the credit market was collapsing. So the value of bonds was declining in value. So anybody that's feeding off of lower asset values becomes impacted in a negative way. And that when the Fed takes the course of what it did in March, April, May, into June, then, it disproportionately benefits those people that either hold financial assets or those that are facilitating financial transactions that are tied to asset value.
Yeah, so it kind of sounds like the investment bankers like asset inflation because they can charge those fees and so on. And over the past couple of decades, assets have gone through the roof. So they seem to be making a lot of money off of that.
I'd say that's true. It probably goes further than that. If you look back to the financial crisis, and I think a lot of people that now are thinking about Bitcoin and kind of the consequences of a fixed supply currency and a currency that can be manipulated and debased, and you see a lot of people talking about the expansion of the wealth gap. That yes, anybody that is deriving a source of income off of financial assets or the credit system are benefited, but more generally, anybody that had assets in 2008 versus those did not disproportionately benefit. So when we think about the increasing divide in terms of that wealth gap, I could really simplify it down to the people that had assets versus the people that didn't. So like say you were coming into the economy in 2008, if you already had assets, you were effectively bailed out, or if you were a company that derived income based on the size of the credit system or the value of financial assets, you disproportionately benefited. And if I was thinking about that in a micro world, think about somebody coming out of college, around the time that I did, or the younger generation. Well, the value of real estate is propped up. So if you want to get a mortgage, maybe the value of I think the median value of a single family home was $300,000. If the Fed didn't come in and manipulate it, maybe that would have been $200,000. Now it's $350,000. So when you think about the amount of income you have to generate to be able to then buy a house, a much larger share of your income would have to go to it. So I don't think it's some evil scheme that the Fed sits around and thinks about ways that they can screw over poor people and advantage banks and anybody that's really plugged into the credit system. But that is the ultimate consequence of the structure of the system.
The system seems to be trying to perpetuate like a false stability, if you will, right? Like it's always sort of trying to keep the status quo going. Is that what's motivating all of these incentives?
I think so. So if we just think about the Fed's mandate expressly, which is price stability and full employment, which I think we would both agree that having a central bank have a mandate of full employment sounds a lot like social engineering and just feels like a fool's errand. Like how can a couple people sitting around deciding to print money be able to achieve a greater employment, because the operation of printing money by definition doesn't create anything in the real world, and that people do that. So I think that ultimately they're trying to achieve short-term stability, and the consequence of that is that they don't tolerate volatility or price discovery. And it's actually that price discovery or volatility that is communicating a shift in preferences, or communicating where imbalances exist that need to be resolved before an economy can start growing again. So I think about it as they have a mandate to achieve quote price stability, which in their world means devaluing the US dollar 2% a year. If I was to really key in on what they're doing, it is in order to maintain some price level stability, they have to maintain the size of the credit system, because the system is so financially levered. So whether it's auto loans, credit card debt, mortgage debt, the credit system is many multiples larger than the base money supply. So in order to maintain quote price stability, they have to maintain the price or the size of the credit system. Essentially what they're doing is maintaining the size of the credit system to maintain the asset prices more generally, because if they don't maintain that, then quote price stability can't be achieved. So ultimately the consequence of that, in my view, is they are trying to achieve short-term stability at the consequence of long-term volatility. Like essentially they're suppressing volatility that exists, and the market is trying to reset or adjust to eliminate imbalance. And the Fed, knowingly or unknowingly, I'd say probably unknowingly, that they just don't understand it, they're not seeing the field clearly, they're suppressing that volatility that already exists, and it causes for greater blowups. And that's what we saw in 2008, and that's also what we saw.
Wow. So this is all so crazy, because if you think about it, like things are supposed to kind of change, and they're trying to suppress any sort of change from whatever it was. It sort of keeps them in power or something. I mean, do you see a conspiracy here, or is it just sort of good intentions gone awry?
So I am a conspiracy theorist, but on this one, I think it's more misguided, and that they, again, if I go back to my schooling, never really thinking about monetary economics. Like if I not even say Austrian economics, just thinking about money and what it is, and like forming a baseline as to whether or not there's a world where you couldn't manipulate the money supply, and then there's a world where you can, and what the consequences of those two worlds are. Going through school, and this is really kind of if I was educated this way and I studied economics, then practically speaking, anybody who's going to a university in the United States, like they're only effectively taught one way, and it starts with a baseline that active management of the money supply is good. So when you only are ever thinking about that world, you're never questioning the root level principle, and really, and not in a pejorative way, but what that results in is a central bank that's inherently made, it's a monoculture, not necessarily by design, but by definition. So if you thought about somebody that had an opposing view that said active management of the money supply is bad, that person would effectively argue that the very existence of a central bank is not just obsolete, but that it actually causes harm. And so if you're working within a central bank, you effectively can't have that perspective because you've already been trained and formed the belief that it's good. So I think more realistically, it's a group of people that have never considered that alternative, truly, in terms of what are the consequences of the actions that we're taking. And one of the quotes that I often bring up that speaks to the psychology of the central bank, there's a quote from Bernanke, and I can't quote it verbatim, but he effectively says, "I'm willing to accept that monetary policy or monetary policy solution is not the root problem, and that it can't solve fiscal and structural problems in the economy, but we have to be palliative." Essentially, I can accept that I'm not the solution, but I still have to do something, which is a crazy way to think, but that, in a non-greater conspiracy world and in a more innocent way, that is their psychology. That, okay, if the world is seemingly burning around me, I have to be doing something, because if I did nothing, then people would,
blame me.
They'd blame me. Whereas not doing anything is sometimes the right answer. And I think on a fundamental perspective, and I think it's easier to think about in micro examples, but say when I see the stock market crashing, I look at it as saying the economy, the people that make up the economy are changing their preferences. They're saying, I would rather have dollars. I need dollars. I don't want to own the financial asset. And that's actually the economy and the pricing mechanism working, saying, they're communicating their preferences. What effectively happens when the Fed comes in to put in QE, they're basically saying, hey, you, the economy, you're wrong. And I'm going to give you the dollars so that even though you're saying that you need more dollars, I'm going to give them to you so that you can have your cake and eat it too. But that ultimately changing prices is the economy, in certain ways restructuring, but the individuals that make up that economy communicating a change in preferences. And that if you don't allow that function to happen in an undistorted way, you naturally get price levels that exist in ways that they wouldn't otherwise would in an unmanipulated way. And it doesn't just change the pricing of housing, it manipulates all prices, but effectively, because prices don't adjust on a pro rata basis, it structurally changes the economy in a way that it wouldn't exist in, if not for that act of providing more dollars to certain sector of the economy, others. And that ultimately, coming back to the base question of kind of how or maybe two questions ago in terms of the Fed, the mentality of the Fed, they're maintaining short-term stability at the consequence of long-term volatility, but they're also structurally changing the economy through, how it is and what, the reason why they're providing more dollars in terms of the objective that they think that they're achieving. It doesn't just say, okay, home prices are going to go up by 20% now because we're going to advantage, a sector of the economy that relies more heavily on cheap access to credit. More people then go figure out how to build homes than they otherwise would in that world. And that structural change is much more pervasive than just like, oh, prices need to come down 20% because they're too high. It's like, no, you're creating structural imbalances in, that would otherwise not be able to be sustained if you weren't causing false signals to be sent to people by constantly screwing with the money.
So, you're now into Bitcoin and you've been studying it for a while. Since you've learned all this, how do you think that stuff changes as we go into a more Bitcoin-centered world?
Well, I think most fundamentally, it just strips that ability away. So it says, I don't care what your economic debate is, what whether you intellectually think that quote, managing the price of money for short-term stability, and whether you think it results in long-term stability or not, we're just going to take that ability away from them. So, sorry, but we're now competing. So I think of it as before it was more of a philosophical debate and intellectual debate back in the, went back further than this, but there was the time when the Austrians were essentially debating the Keynesians, and essentially the Keynesians won, and then that became the monoculture. But it was a debate. Now with Bitcoin, it is the polar opposite monetary systems that are competing with each other, and we're going to see which one.
Well, it's interesting that you bring up competition, because it seems like what you're saying is that in order for sort of like the Keynesian system to win at all, they kind of need a monopoly. Is that right?
I would say that, I guess, monetary systems are monopolistic, so they probably don't coexist. So if one wins, one's going to win kind of categorically or kind of in aggregate, and then that's going to eliminate the other. So I do view it as, I don't necessarily say that for Keynesian to win it has to have a monopoly, but that naturally, if you're centralizing, whether you have a Keynesian view of economics or you have a monetarist view of economics, you're both ultimately, probably for different reasons, supporting the centralization of money. It may be a derivative of, arguing for, on the Keynesian view, basically arguing, if I was simplified, it's a lot more complicated than this, but arguing that there's a role for government in helping to essentially provide funding to an economy to help smooth out business cycles. Well, you can't do that as the government ad infinitum if you don't have a central bank that's derivatively financing the government. They may not be doing it directly, but they're doing it implicitly. If you're a monetarist, you're basically saying, okay, there's some benefit to gradually expanding the money supply, but then once you open up that Pandora's box, it's like, well, what's the right number? Is it 1% or 2%? But then once you say, well, it's fundamentally good, then it results in QE. So I think the ultimate consequence of that is it's less so, a Keynesian or a monetarist needs a monopoly in order for their system to work, is that because money is monopolistic, kind of if a certain monetary system is winning out for a period of time, and if the money system is working, it is going to monopolize. Now that we have competing forms of money, or a competing form of money, and saying like Bitcoin's competing with the dollar, that Bitcoin's competing with the euro, yen, yuan, bolivar, peso, that if somebody decides that they want to own Bitcoin, and that is a better way to store of the value that they're saving, what they put in a monetary medium, when they make that decision, they're opting out of one monetary system and into another. And it doesn't happen necessarily all at once in terms of, I still own dollars and I own Bitcoin, but I'm identifying increasingly that for what I save in money, a greater and greater share of it should be in Bitcoin. But at that point of that decision, if I was to trade dollars for Bitcoin, the exact same number of dollars exists as do Bitcoin in terms of like a secondary market sale or trade, and whether it's me trading for dollars or trading for goods and services, that I'm making the decision of putting a higher value on one monetary medium versus the other. As that wheel starts to get going, the value of a monetary network increases as more people join it, because there's more trading partners, there's more people, there's more functional use for the money, that it essentially it's coming at a direct consequence, not just at a derivative consequence. I'm actively deciding to store in one versus the other. Well, the more people that you have shifting over to Bitcoin, the less people that are demanding dollars or euros or yen, and ultimately it causes that system to not just there's not going to be a steady exist, and both of them kind of exist in parallel. They will for a period of time, but one will ultimately win out over the other. And what we're going to see is how many people, and they may not even know it or be conscious of it, but how many people choose to store their money in a fixed supply currency versus one that's actively debased. It's just going to be an instinctive shift, at a certain point. A lot of people today have I don't want to say a lot of people, but people today, you and I, we spend time thinking about it actively. Most people aren't ever going to have to make that decision. They're just going to respond to price signals.
That's interesting. What happens to all of this financial infrastructure that's been built up. I think you were saying something like 16% of GDP. We don't know if that's the right number or not, but it's a significant part of the economy. And, you know, as you suggested, it's probably significantly bloated. What happens to all of that? Like, do governments continue bailing them out or do they collapse on their own? What happens as more of these people move and store value in Bitcoin?
Well, I think that first I would say that one of the consequences of Bitcoin will be a definancialization of the economy. And so if I was thinking about that conceptually, it would be, there's this idea, and I think it's one of the greatest lies that's been sold, which is you have to make your money grow. You know, it's like there's industries built on that idea.
That's right.
Right.
Yeah.
And a lot of that is built on this idea that your money's the dollar or any fiat currency, it's slowly deteriorating. So if your dollar is depreciating 2% a year and you multiply that over a decade, 20%, 2 decades, 40%, that in order for you to have what you need at the end of 2 decades, you have to have made that money grow. If you just sit there in dollars, it's going to be worth 40% less when you're getting towards a retirement age. And so a whole industry is built up around, you know, how do you make your money grow? You invest them in financial assets, you know, type of a world, rather than say, take that money and invest in yourself in terms of a skill that you, so it's, and if I was to simplify it, it's like you create value in the world, you get paid money, and then you're, you know, system-wide or economy-wide or population-wide then told to invest that money in somebody else rather than, and that in a world where your money is not depreciating 2% a year, 20% over a decade, you're going to, the incentive to just save in money that appreciates over time versus building off that assumption that it's going to lose value will cause, you know, it will reintroduce opportunity cost in a free market way. And that the derivative consequence of that is that fewer people will then be immediately taking their money and putting it at risk, because that's essentially what's happening when you know, they don't think about it that way. They think about the stock market as liquid. And so just the incentive structure alone will shift the inclination of people to take the money, and essentially the money is what you get when after you've taken risk and been compensated for it, and then perpetually taking risk. So fewer people, and to a less greater extent, will be immediately plowing their money into stocks and bonds. It will cause the size of the financial system as a whole to shrink. Then to your question of, well, what happens to all those resources that are devoted to banking? And essentially the economy, you know, I don't know, but holistically the economy needs to restructure. And but I think it's the exact same if we think about any advancement in any technology. Like if it becomes easier, you know, if technology advances in telecommunications, if it's doing its job, it should be demanding fewer of the resources of the overall economy, so that then a portion of those resources can go and do some other function, because we've automated. That if Bitcoin works, which, you know, my perspective is at this point it's inevitable, that if we just came out on the other side where the financial sector and the banking sector was consuming 16% of the resource, it's almost like a success in Bitcoin dictates that number will be far smaller, because it wouldn't provide a step function kind of change innovation. But that if it is, that, you know, again, don't know what the right number is, but maybe it's 3% of the resources in the economy, or 5%, or maybe it's 8%, but it's just the same as restructuring of any economy. Like thinking about on a micro level, we shift over from Blockbuster to Netflix. Well, Blockbuster was a large employer, but now theoretically that, you know, either it's different types of skill sets and resources, or it's fewer, but we can deliver the same type of service but direct to your home. Well, now all those people at Blockbuster need to go for new jobs, and they all individually look at the market and say, okay, well, where, based on the price signals and the incentive structure of the economy, do I go? And I think that's going to happen kind of, you know, it's not just going to be confined to the banking sector, right? Like I think that if, you know, pricing houses adjust because people can no longer get 2% mortgages for 30 years, there's going to be probably a lot fewer people that are going and figuring out how to develop single families or 70 story skyscrapers. So it's not just going to impact kind of one sector of the economy, but overall the economy will have to restructure based on a new pricing mechanism that's probably providing at the onset, it's probably going to kind of create some economic disruption. But ultimately that's kind of natural or core to the function of an economy.
It's interesting that you brought up how the banking system kind of relies on a lot of people wanting to take risk, and that they sort of almost lie to them and tell them that they're not really taking risk by trying to make their money grow, that putting it in a stock market or bonds or whatever. That seems to be sort of juice that they get off of all of the risk taking starts to go away. Does that mean that we're more productive as a result? Like, what are the consequences of all of this risk taking being sort of taken off the table? I mean, I guess like a Keynesian would say, like, okay, there's not as much money to fund startups and things. Like, wouldn't that be a bad thing?
Well, I would say that it doesn't prevent risk taking. It just ensures that those that are taking risk are being compensated, right? So one way to think about it would be, if the free market was setting an interest rate, then and the interest rate should be dictated by the overall growth in an economy that finds an equilibrium to reward those people. So, somebody has money in their bank and all of that money is being recycled through the economy, and they're whether they're willingly taking risk actively, they're implicitly taking it because somebody is rehypothecating it and lending out. If people basically had a gate that said, oh, if you want my money, you have to provide me an opportunity and give me the share of economics that's fair, then more people are essentially participating in the, ultimately by creating a better savings mechanism, more people are taking, an active participation in setting market interest rates. So thinking about an equilibrium, maybe the equilibrium interest rate, and there is no true kind of interest rate, but just thinking in a micro world, it's 8%. Somebody's sitting there and evaluating it. Well, for 8%, I'm not going to lend my money, but other people maybe will too. And then somebody may say, well, I'll pay you 9%. And then maybe I marginally make the decision to say, okay, well, if I'm going to take this risk, then 9% is fair. What's happening today is essentially for money that people have in their bank, or maybe the best way to think about it is if you ever went to anybody and asked them, would you lend your money to somebody who wants to buy a house for 30 years at 2.5%? Every single person would say no, but it happens all day long, right? So, and that is ultimately to say, what would be the fair market rate if individuals that were actually bearing the risk were pricing that mortgage? It would be far higher than 2% and it probably wouldn't be lent for 30 years, right? So it's not to say that risk won't be taken, and we'll just reintroduce the true opportunity cost of money and will dictate that based on an undistorted pricing mechanism, that naturally the risk and the capital will go toward the more productive types of activities. The compensation structure will be more aligned, and that if somebody takes risk and loses money, it eliminates moral hazard, and that's part of the kind of price setting mechanism and risk taking kind of productive function of an economy.
This reminds me of what Andrew Jackson said about the central bank, which was that when you win, you make out with all the money, and when you lose, you get somebody to bail you out. That sounds kind of like how banking works, is that the people that are depositing with them are taking all of the risk, but they're the ones that make all of the profit. And what I think what you're saying is that a lot of that money, instead of going to these bankers, goes to the people that actually bore the risk, which are the people that lent the money.
Yeah, but in this structure, most people that have their money in a bank, their funds are being lent out, right? Fractional reserve banking, and there's nothing inherently wrong about somebody attempting to fractionally reserve. It's just that if they do it poorly, and there's a run, that structure and all of the stakeholders in it, the losses should be contained therein. So if I'm a depositor at a bank and the bank has a certain amount of equity and they've lent money out, and and the people that they lent money to did not achieve the returns that they expected to, that the consequences of that in a free market would reside first in the equity holders of the bank, and then second in the depositors of that bank. And if the depositors lose their money, that bank's out of business, and they can either decide not to enter into a fractional reserve scheme in the future or choose a better partner. What exists in this world is that those kind of the largest banks are consistently bailed out, which again introduces moral hazard, which screws up the entire incentive structure. It fosters people that are taking risk that's essentially borne by others, and it extends beyond just the four walls of a bank. It extends to essentially to what you were describing, privatized gains, and really even privatized gains that aren't shared with the depositors. It's almost like inherently exists within the shareholders and the equity holders and the management of a banking structure, and that when the shitstorm comes, then they're bailed out, and they don't explicitly know they're going to be bailed out, but because of the track record and the history, the expectation is like the idea of too big to fail, right? Like it didn't work because effectively the Fed bailed out Lehman Brothers, and then they let, or the Treasury and Fed combined, and then they let Lehman Brothers fail. I think they tried to do that as a signal to say, hey, like, you're not necessarily going to be bailed out, but then they had to bail out all the other banks, which basically, it was
a sacrificial lamb.
It was a sacrificial lamb, and it was for naught because everybody else, called their bluff. They're like, oh no, you can't let us all fail, type of a thing. So I think that ultimately, coming back to Bitcoin, it's that if you have a fixed supply currency, it doesn't say that the Fed can't exist. It doesn't say that fractional reserve can't exist. It just says if you want to bail out anybody in the future, you're actually going to have to capitalize it, and you're either going to have to tax people to do that, or put money, tax people and put money in actual Bitcoin at the Fed to perform that function. But if it runs out, it runs out. And I think the natural consequences of that is that the bank bailouts don't exist, and that ultimately the people that are taking risk are going to have to live with that risk. It's not going to necessarily result, or it will not result in no risk taking. It will just fundamentally restructure how risk taking is pursued, and then the compensation structure for the various different constituents in the supply chain of risk taking.
It's interesting. I never thought of banking as a form of getting money off of risk taking, but who bears the risk and who gains it seems very often. I think you're right. There is a giant moral hazard. Do you see a place for banks in a Bitcoin world? Because you can kind of be your own bank. So, assuming everything works out kind of how you see it.
I think that there's going to be a very large consequence of Bitcoin, and that's when I talk about how it's definationalizing the economy. So it's not to say that debt won't exist, and it's not to say that the stock market won't exist and that there won't be joint stock companies or joint ventures that kind of benefit from pooling capital. I do think that in the future Bitcoin world, the size of that type of activity will be far smaller. It's also not to say that the only function of a bank is capital allocation, though I do think that there is, maybe one way to think about it would be there's value to capital allocation. It's happening in a much larger way than it otherwise would if the incentive structure of a money was more aligned with the person that's creating value and storing it. But that banks do not exclusively allocate capital. There's whether you think of there's a lot of different pieces in the value chain of helping move money around, and banks help facilitate. Now, Visa and MasterCard aren't banks, but they leverage the banking infrastructure to help facilitate payments, and that individuals are ultimately relying on their banks and Visa and MasterCard to help do that. And I don't necessarily know what exists kind of in the future Bitcoin world beyond kind of expecting those functions to be far smaller. There are still benefits, and probably more so in the Bitcoin world, to the benefits of trade and specialization. An individual, if we think about are individuals going to be relying on third parties in some functions and capacity to help move and transfer Bitcoin around? Not everybody has your skill set to be able to code your own wallet, and so it's unclear where that stops and starts. People if they're being their own bank, they're still relying on a third party to provide, in most cases, to provide them with a hardware wallet in order to do that. And that's one function of specialization. So they are their own bank, but they're relying on a third party to provide them that device. In terms of the context of what we're doing at Unchained, we're trying to build kind of, I would say, we're not a bank, but we're trying to build a financial services platform that we think adds value to the structure of Bitcoin, where individuals can hold their own keys. But one of the things that we run up against principally when they're thinking about that decision point of holding their own keys versus using a Coinbase is, if I have a material percentage of my wealth, am I going to lose it? and being uncomfortable with that, and helping them not only have access to technology, but being there as a partner should they ever have issues in the future, and then the value that's extracted by our one key being a third of theirs, such that if they do lose something, that we can help them, so that they're like perennially afraid of basically being their own failure point. So again, it's impossible to predict where the kind of the function of bank stops beyond knowing, or at least having a very clear view in my view, that the banking sector as a whole will be far smaller. It may be doing different things, kind of and adding different value, given that Bitcoin is a fundamentally different type of money, and that lending will be, not necessarily in terms of, probably far fewer people will be borrowing and lending, and that far fewer people will be just making money and putting it into a 401k and buying 30 different stocks that they have no idea what they're buying. But that those functions themselves will still exist. It will just probably be more direct risk-taking of indirectly of assets.
Do you see any downsides to a Bitcoinized banking sector?
I think that there is a fundamental... There's probably a risk that I think is often associated with banking that extends more towards law and Congress, which is financial privacy. So there's certainly a consideration around kind of AML KYC, right? That, if I was thinking about balancing security considerations, that the privacy is part of the equation, right? And then you would say, okay, well, is that something that's systemic to banks, or would I look at it as, if not for, say, like AML KYC rules, would this service add value to someone and something? And by not providing it, kind of where do you find that balance? And so I do think that there's certainly benefits to specialization for whether it's somebody providing a hardware device, because if I I can say, I don't know somebody's balance if I just send them a hardware device, but I know that they have Bitcoin now, or and in the future we're going to know that everybody has Bitcoin because everyone. I do have a view that Bitcoin's monopolistic. So there's nothing that stops from a court from going to an individual and saying, hey, turn over your
hardware wallet,
or disclose your addresses. It's just changing where the decision point is. So I do think that there's risk. I think ultimately Bitcoin fundamentally is going to change far more than just our monetary system. That there's going to be economic consequences, going to change how people think about a lot of these problems, and that ultimately kind of the requirements on the banking system may be different when you're living in a world with 300 million Bitcoiners rather than 300 million.
So interesting, and that sounds like another whole episode, like how Bitcoin changes how we think about politics and things like that. But let's get back to the banking industry and what you see. What do you hope happens long term with Bitcoin with respect to this industry in particular? Fundamentally,
Bitcoin's not, quote, doing its job if it's not shrinking the sector. So I think that's true of any, again, I think we talked about it before, but anything, like any
innovation.
Innovation should consume less human resources. Not, that's probably an oversimplified way to do it. If somebody develops a new technology, because I would think about it as like Bitcoin is a step function change innovation in a monetary medium. You can look at it today as saying, well, more people are working on Bitcoin, so is the financial sector not still growing today? But ultimately, because it eliminates a lot of infrastructure that otherwise wouldn't need to exist in the long term, if you think about it, kind of the financial system broadly, it will and should. When any new industry kind of kind of starts to get stood up, then you could look at it and say, well, it's actually consuming more resources, but it's because you have to develop the infrastructure before the infrastructure can actually be leveraged. So I wouldn't say that's my goal of like what happens to the industry. It's more that it's a natural consequence of what derivatively should happen if it's worked, that it will. And again, I don't necessarily think of it as a goal, because I think about Bitcoin as Bitcoin as a monetary medium is going to fundamentally change everything. I'm not, it's like the pretense of knowledge, where it's like, I don't, it's kind of like chaos. Like I know that this is going to be good. I can't predict how it's going to change people's behavior, because it's essentially going to strip away something of power that exists in central banks and ultimately results in financial engineering. But what that future world looks like is impossible to predict, because the distribution of the monetary capital in the world will be fundamentally different in a world of sound money.
What are you working on now to make that a reality, and how do you hope to capitalize?
One, I have a fundamental view that the most important thing in the value chain of Bitcoin is keys. And that the more keys that exist, I almost think about it like as the Second Amendment, where like the more guns that exist, the less likely there is for like a tyrannical government to oppress millions of people. And that if more keys exist in the world, then the ability for the Bitcoin network to be co-opted is kind of deteriorates, kind of correlated to the number of keys. Because ultimately what that means, that's speaking at a system level, but ultimately what it means on an individual level is, when we were having that conversation about a bank, that whether you know it or not, or lending out your money willfully or not, it's gone. I don't look at savings as exclusively on the monetary sense, because I think of it as like money is just a tool to accumulate other capital. But if you have control of your money, and that maybe that is a goal, which is that more people kind of put those gates up, so that not to prevent risk taking, but that if you want my monetary capital to go take some risk in the future, you have to ask for my permission
and compensate me.
And that if that key exists, then the only way for you to get my capital is for me to voluntarily provide it to you. And that in that world, you're ultimately going to have, I believe, more people more investing in themselves, and you'll have a not just a more decentralized risk-taking function, but it will be less big companies, more small companies, more localized economies. And so my goal, kind of individually, what I'm working on now is helping to build a company that helps enable more keys existing, not knowing 100% what that future world is going to look like, but that if we're helping people secure their Bitcoin better, that then if we're providing a financial service or banking-like service, it's basically then being able to go to those clients and say, hey, we have this opportunity. Would you like to do it? This is the rate. And for those clients that want to participate in that capital allocation function, they can. Or if we're helping people facilitate Lightning payments, whether it's through open source applications or a private application, in the future, which I expect us to do, that we are helping deliver value to people in a way that not just allows them to feel more secure over their Bitcoin, but that when it comes to the decision point of either taking risks or moving their money around the world, they're in control of that, and that the incentive structure between us as Unchained and our clients will always be fundamentally more aligned if the foundation is built on it.
That's so interesting. I never thought about control of keys as ultimately leading to better or more just value capture, because I think you're right. Like, a lot of the value capture happens in the financial system, in the banking sector, rather than at the end point of the people that are actually risking things. So
if you think about the benefits to, like, think about a bank and think about the constituents in that bank. You've got depositors, sometimes you have debt on banks, then you have equity, and then you have management. Depositors extract the least amount of the value out of the value chain, and they should get the most.
Keys are sort of central to making sure that they do, because then they have the gate, or
it's almost like, what if in the Bitcoin world, you should never live in a world if your expectation is, I just want to save money in Bitcoin. You should never be presented with the option of being forced into a world where, unbeknownst to you, your Bitcoin can be rehypothecated, because that is like something that you should be voluntarily opting into to say, okay, I want my Bitcoin to be, capable of being lent or not. If you were thinking about kind of like a traditional depositor, how people think about their deposits, they think about their bank having their money. When in reality, it's not there. It's been lent out to somebody else. And that's one of the things that probably certain people say, why should people, when they think about paying people deposits at banks, why should you get compensated for not taking risk? Like that's something that consistently comes up within like the Keynesian world. It's like, no, in order to get the money, you already took risk. You shouldn't have to perpetually take risk. And if you are asked to, then you should be voluntarily opting into that. And if you're securing your keys, by definition, if you want to give it to somebody at that point in time when someone's presented you with an opportunity, you're opting in rather than perpetually taking risk as a function of some other party, unbeknownst to you, being a black box lending out.
Or a trusted third party, in other words. Yeah. All right, so we don't have that much more time, so let me ask you the two questions I want to ask everyone that does this podcast. 5 years from now, what's your best and worst case scenario for Bitcoin?
There will be 2 more halvenings. That maybe, let's just say that's the worst case. I can, it's like as soon as the Bitcoin network is still functioning, which I expect it to be. It's difficult for me to see a world that within 5 years, 1 billion people don't own Bitcoin.
1 billion?
Yeah.
Wow, that's a lot.
Or maybe that's a little bit aggressive. Maybe that's a positive case. It's just knowing how I key off on a few assumptions. Money's a necessity. Bitcoin's a better form of money. And the derivative of those two things is that whether people know it or not, they're going to be like having to seek it out.
Because they're incentivized to.
Because they're incentivized to. And it's like a core set of like how people transact in the world, and like that there are benefits to trade and specialization, and that's really what money and a monetary network helps facilitate. I also know and work under the assumption that knowledge distributes exponentially. So when one person figures out Bitcoin, they not just because they see the benefit personally, but they're naturally going to go tell 5 people to 10 people. Like that's just, it's thinking about knowledge distributing on the internet. And this is maybe one of the most important, let's just say it's the most important knowledge distribution event in our lifetime, and will be practically for everybody. It's not unrealistic that 1 billion people will have Bitcoin. It's not like a minimum, but that's certainly a possibility.
I guess that would be your positive case for 5 years.
Yeah.
All right, so 20 years from now, how do you think Bitcoin affects banking? 20 years from now. I mean, you already said it's going to be smaller, and you already gave the caveat that you don't know exactly what's going to happen. But what's your most probabilistic scenario there?
Speaking my own book, banks look more like Unchained than they look like JP Morgan.
Okay.
That there are a lot more, and each of them are kind of in aggregate a lot smaller. That is my expectation, that there still will be banks, and that there will be free market competition. So there will be people who attempt to fractionally reserve banks, and that there will be others that try different models, but that everything will keep coming back to kind of a world existing where risk taking is much more direct, and not necessarily in the sense of one-to-one, but that kind of that there's an opt-in, and that opt-in is forced by keys rather than kind of unwillfully being kind of co-opted in. I do think of it as it's not a hope, that it's inevitable that the sector will be smaller, and that the consequence of that will be, because when we're thinking in terms of monetary units of the size of 16% of GDP, it's freeing up a lot of individuals to be going and pursuing other interests
instead of investment banking.
And that world where you had, say, 13 millions of people doing thinking about solving other problems, that world will be a kind of, I don't want to say better world, that's too generic, but that it will free up human capital to be solving problems that other humans have in a great.
So a shrinking of banking leading to more people doing more productive things that make civilization better. I like it. It. Thank you, Parker, for doing this podcast with me. Is there anywhere that my audience can find you?
They can find me on Twitter at Parker A. Lewis. I write a article series on Bitcoin called Gradually Then Suddenly. So if somebody's new to Bitcoin and looking to learn, they can kind of read up there on our blog on unchained-capital.com. And if anybody's looking to learn about multisig or kind of interested in seeing what we can do for them on Bitcoin financial services side, to reach out on Twitter, or they can reach out to us on our website. But this is an open invitation that anytime you want to record, if you want to record in person here in Austin, you can always use Unchained Capital's office. So.
Well, I might need to take you up on that. Thank you. Well, that wraps it up for this episode of Bitcoin Fixes This. As he said, Parker can be found at unchained-capital.com and Parker A. Lewis on Twitter. Until next time, fiat delenda est.